We're ready. As I said before, please ask all the questions you want, all right? So today we're going to go over a real good subject that I feel really fits the time that we're in right now with the market, and that is how to trade in a consolidated market, guys. All right? Now, a lot of people, it's very hard to be able to identify when you're a consolidated market or not. Yeah, maybe in hindsight, it's easy, but when you're actually trading and you want to keep yourself away from trading, you have to have some sort of catalyst and some sort of nuances that allow you to know whether there is a consolidated market present or not. And we should all know that when you have a consolidated market, no matter what your strategy is, you should dim it down a little bit because there's not going to be much follow through. There's going to be very little participants, not much dynamic breakouts. So you don't want to get chopped around as much, and you want to be able to be particular in the choices of your trades. So let's go over the first slide. So what to expect from this webinar. Now, what I did, I wanted to kind of create this on my own to prep you guys. So how to locate and distinguish a consolidated market. That's one of the most important things, and we'll go through that. Type of stocks to trade in a consolidated market. Now this is important because not every single stock, and especially your favorite stocks, are probably not going to be acting in the fashion that you're usually used to. For instance, Apple. Now, Apple usually moves and correlates with SPY, but sometimes you could find that Apple will just completely consolidate, and it's not going to be the type of stock that you'll be able to trade as you used to just a week ago or a couple days ago. So finding the type of stocks is actually very, very important when trading in a consolidated market. Most of you probably heard this already. It's probably cliche, but patience is key, guys, especially in a consolidated market, because what the market likes to do is suck you in. They're going to go, here's a breakout, and then right when you get in, they push it back down, okay? And the more you get sucked in, the more impediments are going to be oozing out, and you're going to start becoming reckless, indecisive. You're not going to even follow your plan anymore, okay? Another important concept is tightening your setup selection and rules. Now, for some of you, you may not know what that means, but we have many setups in Alpha 7, and not every single setup will work in every single type of market condition, okay? So if it's a very, very dry climate or a very, very slow market, then what you want to do is select the setups that you feel have the highest probability out of all your setups. How many of you have, let's say 5 different strategies, but how many of you know which one works the best? Do any of you have 4 setups, but one always works the best? Okay, Roxy. Good. In anything. In general, Jen. Sorry. All right, but the reason being is because if you were to cut your most lenient setups and only stick to the ones that really do well, then that is a way to survive through the consolidated market. Now, one thing we say is survive, okay? Survive in the dry markets and thrive in the wet markets, okay? So most people, they have this misconception that whatever they can make in a market from a month ago, they will be able to make equally the same every single month, and it'll continue to work the same way every single month. But that's not the case. The market changes, the way it reacts changes, and you have to change with it, okay? Another thing is catalysts. Now this kind of ties into what type of stocks to trade in a consolidated market. Because I'm not going to go deep into it, but think about it. If the overall market is choppy, then what kind of stocks are you going to find that have movement, okay? The only ones that are going to have movement are ones that have catalysts and that they're moving on their own volition. All right? That's what you have to do in a consolidated market. Controlling risk and probability we're going to go over, which a lot of you have a misconception of risk and reward. We actually look at it in a different way. And then increase your performance and limit your losses in poor market conditions and more. So any questions so far before we move forward into the actual webinar? All right. So how to locate a consolidated market. Now we got a couple in here, a couple bullets that are very important. And many of you probably don't understand some of these concepts. So if you have any questions, please let me know. So the first thing you want to do is look at the wider time frames. Okay? The wider time frames are really going to depict what's going to happen on the shorter time frames. Does everyone understand that? Does everyone have a disagreement to that? All right? And on top of that, wider time frames hold the strongest undercurrents. And what this basically means is that the wider time frames, since each bar holds a lot more data and a lot more price action, then it holds more weight. And since it holds more weight, you should put more weight to the direction of the wider time frames than the shorter time frames, because ultimately the wider time frames are going to depict which way the market is going to be heading. All right, so let's give you an example before we move forward. Let's say I have the 1 minute and the 5 minute and the 15-minute going down, but I have the hourly, the daily, and the weekly going up. What do you think the 1, 5, and 15 are most likely going to do? Yeah, pull up, right? Because the wider time frames is what's really holding it together. So now that we got that straight, what you want to do in the beginning or in the morning is start with the weekly, start with the daily, then go with the daily, and then go with the hourly. Now, daily is usually going to be your main squeeze when you're looking for these consolidated markets. And if you look at today's markets, a couple weeks ago, we've been in huge consolidation on the daily. Even if we were kind of channeling up, we were trading around the 5 MA on the daily. There wasn't really any specific direction. So it was really choppy, and you could tell through the shorter time frames that was happening. Now, another way to find consolidation on the shorter time frames is using the Bollinger Bands. How many of you who aren't part of our education use Bollinger Bands? Okay, good. So there's a very simple concept on the Bollinger Bands that a lot of people maybe don't realize. And what the Bollinger Bands tend to do is just like the market, okay? It's a living, breathing thing. So what the Bollinger Bands are going to do, they're going to expand, and then they're going to contract. And then from contracting, what are they going to do once they're contracting? There's only one way to go, right? To expand. And then again, it keeps doing that same oscillation, all right? And this is how you're able to locate either when the market is going into consolidation, when the stock is going into consolidation, or if it's already been in consolidation, or if it looks like it's ready to expand and come out of consolidation, which is also a very important method to understand. Another way to know whether it's a consolidated market is if you have a slow market open and slow price velocity. And what I mean by slow price velocity, this is kind of my own word, I think, is the action in between the 1 minute candle or in between the 5 minute candle. How much action is there really happening in that candle or in that price action? And if it's pretty slow and it's taking time, then maybe you want to kind of consider that this is a consolidated market. Let me stay on the sidelines until I see a breakout on the 1 minute or on the 5 minute to let me know that the market is back in action. All right. And lastly, if the price action is trading in between the 5-period moving average, this basically depicts choppiness and consolidation. And I'll explain why. Now, the 5MA is mostly used to the overall market as a signal whether we're bullish or bearish in terms of price action. And if the price is above the 5MA, then it's bullish. Roxy, what I mean is if it's trading, exactly, if it's Xing through it. Exactly, Roxy. Thank you for the question. So if the candle is in, and I'll show you examples, I have examples. So if the candle is basically overlapping the 5MA on any time frame, really, Patty, but you could start with the daily, okay? If it's trading overlapping in between the 5, it means that the market is kind of indecisive. It's not strong on the downside and it's not strong on the upside. Okay, so the buyers aren't strong, the sellers aren't strong. We don't really know where we want to go. And this is a very good way to point out choppiness and consolidation. Anybody have questions before we move to the next slide? Let's go. So let's begin. Yes. Actually, I have a couple traders that feel more comfortable with the 8. I don't know if they use the EMA, but I know they use the 8, and they're comfortable with that. You could do that if you want. If you would take our education, Roxy, you would know that in level 2, we teach you that after you learn our setups, you have to learn how to derive your own setups from our setups. Okay, so just because we taught you some way doesn't mean that you can't find a specific strategy within our setups. All right, and that goes for another discussion. I think we could do that in the chat room if you remind me tomorrow, Roxy. All right, so a consolidated market on the daily. Let's give you an example. This is a consolidated market on the daily. Okay, we have no channel range. The 5MA. We have most of the candles trading in between the 5MA, and it keeps bouncing off the upper and bottom Bollinger Band with no trend channel. All right, when you see a daily like this, just hold on tight and take it slow because there probably won't be that much follow through. There'll be a lot of erosion setting in. There won't be much participants, and you'll have a lot of mean reversions after getting into your setups, which is what you don't want necessarily. Any questions on whether this is a consolidated market or not? Yellow is the 5, yes. Okay, so you can see I'm showing the Bollinger Bands trading in between the 5MA. All right, channel not up or down. Okay, so we're sideways. Now, a consolidated market on the hourly. So you can see here that after the Bollinger Bands expanded, what did they start to do? Every single time the candles traded in between the 5MA, okay, the Bollinger Band started to compress. And as it compressed, now think about it this way. In our chat room, or if you're intraday trading, you're trading with the 1, 5, and 15, okay? Now the hourly is going to tell you whether the 1, 5, and 15 are going to move at all. If the hourly is moving like this, okay, in this range, do you think the 1 minute, 5 minute, and 15 minute will provide you with enough moves? Probably not. Okay, so it's best to stay away or to be extra careful on the type of trades you take in this type of market, right? Because the wider time frames hold the strongest undercurrents. And I could give you another statement, which is, actually, I'll explain that later. I know which one I'm going to explain that on. All right, so we have the compression. So consolidation leads to less opportunities. Now, during a consolidated market, opportunities dry up. Divergence sets in, and choppy candles trade in between the 5 MA. Now, here's the thing. This is the tricky part. The market will try its best to have you perceive possible setups or opportunities. It will try to play against your impediments such as patience, recklessness, indecisiveness, anger, arrogance, whatever it may be. That is the market's job, okay? The market is going to try its best to suck you in. Now, patience is key in a consolidated market. What you have to do is narrow your perimeters to take only high probability setups with the least amount of headwinds going against your direction. And I'll explain a little bit more in depth what this means. So what headwinds mean is basically factors or compensating factors that are going against our direction. So let me give you an example. Let's say we have the 1 minute stochastic going up, and we have the 5 minute stochastic going up, okay? And then we have the 15 minute stochastic going down and the 60 minute stochastic going down. And you want to go long. Do you think that you're going to have a smooth momentum going upwards when you have 2 charts going up and 2 charts going down? No, right? Because you have other things that are going against your direction. And the less noise you have going against your direction, the smoother your move is going to be, okay? Now, another thing. Many people have this misconception that you have to trade a bunch. Or I have to trade today. If I don't get into even one trade today, something's wrong with me. In a consolidated market, you always want to ease into it and you want to get a feel for it. Okay? You want to be able to take maybe 1 or 2 trades, maybe 3, and call it a day. All right? And the way to do this is you're going to find maybe 20, 30 setups, 20, 30 possible trades during the whole day. But that doesn't mean you have to take every single trade that you see or every single setup that you see. What you should do instead is just become picky. And if you become picky and wait for the right ones, then you're going to be able to eliminate a lot of problems with consistency, okay? And with fake outs and big losses and impediments starting to come out, all right? It all starts from here. So take it slow, be picky, and if one of the stocks you chose to hold off on and it went anyway, who cares? Okay, move on to the next one. You have no time to really dwell on the past. You just have to keep going. There's a lot of opportunities out there. Any questions on this slide? All right. So, picking the right setups. Now, picking the right setups is all about being patient and restricting yourself to high probability setups. Sorry for the redundancy. Make sure to tighten your selection process, and the less you trade in a consolidated market, the better. Okay? Be observant in the beginning and do not take any trades, especially maybe the first 15 minutes. Many of you probably heard that already. See how they pan out, get an idea of the type of market conditions you're trading in. So what I used to like to do, or what I do sometimes, is if I don't have a good feel for the market, what I'll do is I'll look for a couple setups, and I won't trade my first few setups. And the reason why I do that is I want to see how they react to my setups. I want to see if the market has any follow through, or if it's going to pop and then coil back down. I want to look for mini nuances that affect my ability to get in, and whether it be a good trade or a bad trade. So skip your first 2 setups and see how the market reacts to them. If you see that the market is reacting well to them, then maybe you have a good clue into the market that you're heading into. Does everyone understand that? And I'll tell you another thing. Before you ever get into a trade, make sure you are okay with the loss. Before you ever get into the trade, make sure you're okay with the loss. If you're not comfortable with the loss before you get into the trade, then don't even take the trade. Okay? Because then you're going to be full of regret. And you don't want to be full of regret. Exactly. Nuriel, you can't think like that. Especially in the equities market, you're going to have a lot of opportunities. And if you don't find them, like I said, you have tomorrow. All right? You have to make sure that you feel comfortable before you ever get into a trade. If you don't feel comfortable, then you're going to regret it later. Regardless if it's a win or a loss. If you're okay with the loss before you got into it, it's not going to affect you at all. Okay? Because you were prepared. You're okay with the loss to start with. All right, so let's go. Now, types of stocks to trade for a consolidated market. This is a very good slide. So what you want to do in the morning is from 8:15 to about 9:10 a.m. is you want to scan for gaps and dumpers. And also active pre-market activity. You want to find a lot of volume in pre-market activity, all right, as well as gaps and dumpers. And this is how you're going to be able to build a list that may have some sort of catalyst to be able to push beyond the overall market. Okay? Anyone have questions on that? Okay? And if there's activity in the pre-market, then there's even more so when the market opens. Well, after hours is different, okay? Because you prepare yourself for the morning. After hours, I would say that you still prepare yourself even through intraday. But when you want to develop a regimen, you have to develop it from the morning and then have it follow throughout whatever time frame you trade. So at least in the beginning, for most people, they trade in the morning. You want to look for gaps and dumpers. After hours, earnings, I would say. That's about it. Or news, a big catalyst. Now, the stock must have volatility and wide price moves with dynamic price action. Does anyone not understand that? Or need a better description of that? Right? We don't want small moves. We don't want small candle closes. We want volatility, big price moves, and big pops. Okay? You want to find multiple lane breakouts and breakdowns. Things that are continuing to break out and break down, which is basically convergence. And the more convergence there is, the stronger the reaction will be after. Okay? After a pullback. I would say a pre-market. You could look at. I like to do $500,000 in the pre-market. Yeah, that's because well, you have to with the cheap stocks. All right, so let's move on. Okay, so in order to take a trade, you either have your stock correlating with the SPYs, or it has a fundamental catalyst that is moving on its own volition. And let me go deeper into this because this is important. When you're in a consolidated, tight, slow market, such as this one that is choppy or sideways, whatever it may be, it's not a normal, healthy market. What you want to do is limit yourself to 2 types of trades, okay? And this is what's going to help you eliminate noise and also fake outs. So, if the stock does not have a catalyst, there's only one way you should trade the stock. And that's if the stock has a setup, okay? Stock must have setup. And then not only that, but SPY will have to correlate. If SPY is not correlating with your stock, then you should probably not be getting into it because it's going to be a fake out for the most part. Does everyone understand that? And we'll go deeper into that because I put in a very good one. Where we're going to see that? Let's see. That's actually the next one. Okay, perfect. Yeah, it doesn't matter. They can't get all of them. No, it matters. It matters, especially in a dry market. In a wet market, it won't matter much. Okay, but in a consolidated market, you have to be sure that you have as much as possible going in your direction. Okay, gotcha. So next one. So on top of this, what you need to do is either take a stock that doesn't have a catalyst and trade it with the overall market, or find the stock that has a catalyst and is moving on its own volition. All right? Something that is completely contra to SPY. And what contra means, it's completely going the opposite way. And at that point, you know that the stock itself has its own move and it's not being pushed around by the big bully of the overall market. All right, think about it that way. Now, we're going to go deeper into this. So each stock has a correlation, okay? And let's consider the correlation as a whole 1, okay? Now, 0.60 of each stock's correlation, okay, is based on the overall market, on the general market. And this is called systemic risk. Risk that you cannot avoid because it's on global proportions. Does everyone understand that? Anyone have questions on that? So that means that 60% of that correlation of the stock is based on the overall market. So if the overall market is moving sideways, what do you think the stock is mostly going to be doing? It's anything really that it could be an earthquake, a meltdown, anything that affects globally, okay? It has nothing to do with a sector or a pair in itself. All right? Now, it's going to be swimming with it. Thank you, Roxy. Now, the other 40% is non-systemic risk. This is where you won't be affected globally throughout your whole portfolio, but it only affects a certain sector or its pair. Okay, so for instance, let me give you an example. Oil just made new lows. Do you think that's going to affect the airline industry, the airline sector? Yeah, probably, if it's a big move. Okay, but I wanted to give a better example, but I think you guys get the gist of it. So, to move forward, 40% of the stock's correlation is based on non-systemic risk, okay, and it's based on factors only solely on the stock itself and the sector itself. And it's this 40% where the opportunities are created. So you could see right away from what I just spoke earlier in the previous slide that, and especially in a consolidated market, you should either trade a stock that has no non-systemic that has no catalyst, but is moving with the SPY or the overall market, because that's all you'll have is 60% of the correlation with the market. All right, but even better, if you have a catalyst and also you have the SPY correlating, that's for the biggest move. Okay, that means you have everything moving in your direction. So you could take this apart and you could see how you could use them in different combinations. Anyone have questions on this one? All right, so we get into the charts now. So now that you're aware of the percentages of correlation for each individual stock, you can now use an index or ETF following the index. And the reason why I'm stating that is to provide you with an example. So can you guys tell me, is this one correlating or not? Yes. Good. It's not correlating 100%. Nothing correlates 100% between each other, but it's pretty close. All right? Now, it's correlation. So, how about this? No, right? This is apathetic correlation. Okay, and what apathetic correlation means is that the SPY or your stock is not reacting to the overall market. Okay, and if it's not reacting to the overall market, then you don't have SPY supporting your move. And that's not good. You don't want to be trading it with when you have apathetic correlation. All right, this is a sign of a dry market and choppiness and consolidation and sideways movement. Okay. When your stocks and watch lists are not correlated with the overall market and is apathetic, the next best thing to do is look for a stock with catalysts such as major news, earnings, guidance, takeovers, rumors, and more. Remember that 40.40 or 40% of the correlation of the stock is based on the stock itself and its sectors or pairs. So, Netflix. What can someone tell me the story here? What does this look like? What's going on here? Apathetic correlation, yes. I can. Good one, Martin. Apathetic correlation, yes. And also, you could tell right away that this Netflix obviously has a catalyst here. I mean, you probably wouldn't even have to look at the news and know that there's a catalyst here. All right? You have SPY going up and you have Netflix going down, which is also basically could be a big chunk of the overall market on the Nasdaq. All right? So you could see that a catalyst, how 40% of the correlation could really justify the move regardless of what the overall market is doing. So your goal here is to find a way for you to locate catalysts. Okay? How to know whether it's a catalyst. And this is one way, right? Instead of looking at news or being in my chat room, whatever it may be, if you got SPY going up and you got this thing going down, it's obviously showing something called relative weakness. Okay? It's weaker relative to the overall market and it wants to continue to go down. So I wanted to give this example so you guys could see that how powerful a catalyst could really be regardless of the overall market. All right? It's moving on its own volition. Now, here, I wanted to go through some ways you could find very active stocks for free. Okay? So, this is Finviz on the homepage. How many of you are familiar with Finviz? I'll post it out here just in case you guys, finviz.com. I'll add it here also, Finviz, just in case you guys want. All right. Now, what I look at over here in particular is the major news, right? Because that probably provide me with a few clues of what may have a catalyst. Okay? So that's the first on the list for looking for catalysts is you could look at the major news on the home page. All right? And then scan through those and see if anything is moving much better than the overall or general market. Okay? The next thing you could look at is also on top, okay, you're going to find stocks that have either a big change, okay, and high volume, and high volume, right? And sometimes, by looking at these, not all the time you're going to find one that's really good. Sometimes, even with that much volume, it's still going to be light or it's going to be choppy. But these are good ways to find catalysts or things that are moving way on its own volition, let's just say. All right, anyone have questions on that? You guys are a quiet couple over here. Should have seen the last webinar. It was like every slide it was like 15 minutes with the questions. It was great. So, other important sites to find prospects. You got Yahoo Finance, and what I do at Yahoo Finance in the morning is I look for the pre-market earnings today and after hour earnings from yesterday. Okay, So you wanna look at yesterday's after close earnings and also today's pre-market earnings. Right? And most important, you want to see economic news. Right? If you guys do not watch the economic news, you are not serious about trading. You need to know what's coming up ahead. Sometimes it could be a Fed number, sometimes it could be a gas inventory. It could be many things that could definitely move the market. So maybe it's not going to help you in getting into a trade or making money, but it'll help you know if you're in a trade right now, whether to shave down your shares or to continue holding into the number, okay? Guru Focus for fun activity, briefing for tradable news, stock twits I usually like for the trending, what's trending on top, and then I'll also just click on my my stream, and if I see someone talk about something interesting or it catches my eye, I'll look at that as well. And this is also outside of your normal organic stocks. And what organic stocks means is your favorite stocks, right? Everyone has their own group of favorite stocks. Not all the time do they move. So you always have to kind of get other stocks as well into the game. All right, but everyone has 6, 7 of their favorite stocks that they always look at. Now, a lot of people have this misconception of risk and reward. And we don't teach risk and reward. We feel that this is a misconception. And the reason being is because risk and reward makes you expect something that you could never forecast. Okay, so for instance, how many people trade 2 to 1? How many people base their trading off of 2 to 1 ratio? Okay? Okay? 3 to 1, whatever it is, 3 to 1, 4 to 1, 5 to 1, 1 to 5. How many people base their trades off ratios? It's a mistake, guys. Okay? And the reason being, okay, is because you're trying to you're already trying to create a what you're doing is you are expecting a certain number that you don't even know the market is going to provide. So to base a trade saying, hey, since I'm risking 10 cents, I have to make 20 cents. And if you think about it, you can't think that way because the market isn't going to provide you 20 cents because you want it. Okay? That's not the right way to trade. You have to trade the chart. Okay? The chart is what's going to tell you how much you're going to make and how much you could possibly make at the end of the day. That is what really tells you what you're going to make money. So at the end of the day, don't have so much conviction, or don't stick too much to the rules of, oh man, I have to hold on for another 5 cents. If you see it's at a bumper or a support resistance, get out now. Okay? Because you have to think ahead. You have to look at the chart. Don't be stubborn and think that everything has to be perfect in numbers, because you know the world isn't perfect. So what we do is a little bit different here. We go over something called the first one, which is position size plus holding time equals exposure, which equals risk. And I'll explain how this works, guys, okay? I'm going to give you an example of a trade. Let's say, and how many people, tell me how many people have been through this. You're about to get into a huge breakout trade. You're excited, ready to break out. Boom, you get in, and then what happens to the stock? It's on standstill. It falls asleep. Now, you're in a decision, man, do I stay in it? Should I stay in it? I'm waiting for it to move up. It's not going down. I'm not losing money, okay? No, not falls down. Stays the same, right? But even if it stays the same, okay, the longer you hold on to a trade, okay, the greater the chances it's going to fail. All right? So, with that being said, the longer you hold it, the greater the risk. Okay? Now, if you add the next part, which is position size, okay, the greater the position size, the less of the holding time. Okay? Because If you have a bigger position size, you do not want to be holding a big position size for a long period of time. As time goes by, you want to be able to alleviate your position so that way you could even out the holding time and bring everything back to par. Does that make sense, everyone? Basically, what you need to do is always keep position size and holding time even. And if you could do that, you could always even out your risk. Anyone have questions on that? No? I'm surprised. No ratio. No ratio. Okay? Now, you have to add the next part. Probability. Okay? Probability equals pattern setup plus target price. Now, I don't know about you guys, but we have a bunch of setups. Now, each of our setups have a greater probability. For instance, if I find a setup on the 1 minute, okay, for a breakout, is that going to have a higher probability than if I find a setup that's happening on 3 time frames for a breakout? Which one has a greater probability of working out? One that has 3 setups simultaneously or one that has 1 setup? Obviously, it's evident, right? 3. So you could increase your probability by choosing the type of pattern setup you have. And at the same time, okay, exactly. And at the same time, okay, target price has a lot to do with probability. And a lot of people don't understand this. Let me ask you, do you have a greater probability if you have a higher target price, a wider target price, or do you have a lower probability of it filling? Lower, right? So you have to play with these two nuances and be able to mix them up and play around with them. So that way you could be able to manage your risk, okay? And this is the way to manage your risk. You shouldn't think of a predetermined risk and reward ratio. If you have a setup, then the setup itself gives you the ability to get into the trade. Well, you could also partial out as well. What I'm saying is you have to be scaling out as well. That's the whole... Roxy, let me explain it this way. In our strategy, we try to teach you to take a setup from the 1 minute and be able to take it all the way to the hourly. Okay? And the way to do that is you can't take the 1,000 shares that you started off with the 1 minute and then finish it off on the hourly. Otherwise, you're putting too much risk on yourself. So what you have to do is as you get to your targets, you have to limit your position size, which allows you to increase your holding time. And since you can increase your holding time, you could allow it to move to the next wider time frame to develop even further. Okay? And as you do that, you also increase your target price. But you always start with a smaller target price. And what you could do is if it's not a good market, then expect a smaller target price than usual. All right? But by hiring your target price or lowering your target price will increase your probability. I mean, it really depends on the person. Really depends on the person. In the market, you can't really go into such a quantitative base to like get into a trade. It all depends on the chart. You have to feel the chart. Oh, scalping. Oh, well, that's why you partial out, Roxy, right? I'm not saying to get in and then sell all your shares at the lowest target price and call it a day. You won't be able to let your winners ride. Yeah. What I'm trying to say is if you feel it's not going to reach your next target, just lower your target price a little bit. Okay, it'll increase your probability. But you base your target price off of the pattern setup. Right? If it's a perfect storm, then you're going to give a nice wide target price. If it's a 1 minute setup, then you're not going to give that wide of a price, right? It's only a 1 minute setup. Maybe you're going to catch 10 cents, 15 cents, 20 cents if you're lucky, right? But as you move to the wider time frames, you increase your target price and so and so. Any questions on that? We're almost done, guys. It was a long one, I know. Okay. So, look for wider time frames to align with shorter time frames. So I wanted to give you an example of how this works. In a consolidated market, you don't want to be looking at the 1 minute time frame too much because it's going to be choppy, it's going to be sideways, you're going to have mixed signals. So why look at the smaller time frames? Look at the wider time frames and plan ahead, okay? So, for instance, if you look at the hourly, okay, we have something called the mini pup here, all right? And obviously, I was able to see the mini pup on the hourly before I saw any other setup on the shorter time frames. Would you agree that's how it works, right? The wider time frames you always see before the shorter time frames develop. That's why I said the wider time frames hold the strongest undercurrents. So, now that I saw on the hourly, okay, a mini pup, I mark the price of that entry, and then what I do is I see if the shorter time frames are going to align with setups as well to provide support that the hourly will continue its move up with the setup, okay? And as you could see, as we get more into time, we see that it's starting to develop what we wanted. Right here it was up, down, which is right here, and then up again, and now it's pulling up. And look at that, we have a trend continuation here. We have a mini pup here. We have a trend continuation here. It's like all the planets that are aligning together. This is what you want. No, you cannot turn off the pre-market data. You cannot, because then your indicators will be skewed. Never do that. You need to have as much data as possible. You need all the intrinsic value. You need all the Sony guts. If you guys know that joke. All right, so what you need to do here, and what I'm trying to show you, is that when a market is consolidated, instead of watching paint dry on the shorter time frames, look for wider time frame setups and then plan out your trade. And when they start to align, if they do, then you get yourself ready for a nice setup. And as you can see, hourly came into the 15 came into the 5, the 5 came into the 1, and boom, blasted away. Does everyone see that? I mean, everyone sees that, but does everyone understand how that works? Right here. The 15-minute you mean, right, Roxy? No, 15-minute. 60-minute, 15-minute, 5-minute, 1 minute. Got it? Cool. So, lastly, more important rules to follow. Remember that in a consolidated market, moves are very short-lived for the most case. So don't expect to get too much. Don't get greedy. Don't have big eyes. Take base hits, and sometimes you'll get a home run. That's how you have to think. I know it's cliche, but there's many different cliches just like that, right? What's the other one? Shoot for the stars and maybe you'll hit the moon, right? But it makes sense. So make sure to be stringent in your setups. Do not take every setup. Let yourself get a feel for the market. Don't feel like if you miss a trade, you're missing the biggest opportunity of your lifetime, because more opportunities will always come. So be patient. Feel for the market. And then once you get a feel for the market, you'll see how much better and how much more calm you are when you get into trades, okay? Because it's all about being prepared. Now, wait for the 1 and 5 minute to begin to expand before taking another trade unless it is a catalyst. So what I'm trying to say here is if the 1 minute and the 5 minute are really tight, okay, then wait until it expands before you even consider taking a trade. And what that does, or what that helps with, is to eliminate fake outs or possible fake outs of anticipation of a big breakout, right? Because if your anticipation goes wrong, it could coil down the wrong way badly. So what we do is wait for it to expand, then settle, and now we know that the market is back in action, and you wait for the next setup. This is a very good way to be able to take a moment to take a step back, to take 2 steps forward, okay? And the best moves have correlation and a catalyst in one to take advantage of systemic and non-systemic correlation. You want the best moves, guys? You want to eliminate all the fluff? You want to find only 1, 2, 3 good trades a day? Stick to this, the last bullet. I guarantee it'll increase your consistency, okay, and your performance. Lastly, we'll come off with a quote that we finished with level 1, and I think it's a very good quote. And sorry for those of you from Alpha 7 that you have to hear this all the time. A skilled fighter places himself in a position where defeat is impossible, yet never misses the opportunity to defeat the enemy. Now you could see how this could be related to the stock market. Right, guys? After all we just talked about, what is the point of this quote right here? Is to put yourself in the best position, okay? Stay away from the noise. Stay away from what everybody else is doing. Look at what you want. Look for the best possible strategies. Look for the ones with the least amount of risk downside or upside. And look for ones with the best caliber. And what I mean by caliber is, let's say, for instance, you have a cup and handle. Everyone knows a cup and handle. Now, you could have 2 types of cup and handles. Let's see if I could draw here. All right, I could draw. Let's see if I can change the color. All right. Okay, so what was I saying? Okay, so here's a cup and handle. Hey, how come the color didn't change? What's going on here? All right, anyway, here's a cup and handle, right? Now, not every cup and handle looks this good. Some cup and handles will look like, you know, it won't even go to the highest one, and then it'll go down, and then it'll go like this, okay? This is the difference between a good caliber and a bad caliber. Does everyone understand the difference, what I'm trying to get at? The formation of your setup is just as important as everything else, okay? The clearer it is, the stronger it is. The weaker it looks, the worse it's going to be, okay? So quality is definitely a big reason to get in. What do you mean, Joe? How do I erase this? Yeah, that's a good point, Roxy. I like that. Oh, exactly. It's not as clear as it should be. What you want to do is you want to find ones that are basically very clean cut. You know what I mean? They're following all the rules. The curvatures are there. If you have that setup compared to this setup, you obviously know which one is probably going to work out most. And that's about it, guys. So we have a 7-day free trial for those of you who haven't done it, and you could click on it on the web links here on top. And if you guys have any questions, I'm open for questions. Yeah, Jen, you already took advantage of it. Don't you see your last name? Right by your last name? Any questions, guys? Now, before you guys leave, I'm recording this. If you want the recording, please give me your email. Message your email right now in the chat box. I'll have those out to you tomorrow. The latest at aftermarket, maybe. So leave your emails, guys. My pleasure, Joe. Yeah, I have. Go to my YouTube. Here, I'll put a link up